Imagine losing your home, your savings, and your job within weeks. That's what millions faced in 2008 when the world plunged into a devastating financial crisis. But what caused this collapse? Today, in just 10 minutes, you'll understand what happened, how it impacted the world, and most importantly, what you can learn to protect your finances. In 2008, the world faced one of the most turbulent moments in modern economic history. Banks collapsed, the U.S. housing market crashed, and economies worldwide fell into recession. For many, it seemed to come out of nowhere, but the warning signs were there all along. It all started with something seemingly positive, the dream of homeownership. U.S. banks made mortgages more accessible, even for people unlikely to repay in the long term. These loans, known as subprime mortgages, quickly inflated a massive housing bubble. The problem? When people began defaulting, the bubble burst, triggering a chain reaction that rocked financial markets, businesses, and families globally. At the heart of the 2008 collapse was the U.S. housing bubble. But what is a bubble? Imagine home prices climbing because everyone believes they'll keep rising. This creates a cycle of rising demand and prices, but with no solid foundation. Before 2008, banks issued risky subprime loans, betting that property values would keep climbing. They bundled these loans into mortgage-backed securities sold globally. It seemed foolproof until defaults began. Foreclosures soared, homes flooded the market, and prices plummeted. This triggered something far more dangerous. When the U.S. housing market collapsed, the fallout spread worldwide. Why? Because the financial system is interconnected. Mortgage-backed securities, thought to be safe, had been bought by banks and investors globally. As defaults rose, these securities lost value, impacting international banks, pension funds, and insurers. Massive losses created mistrust in financial markets. Fear spread. Banks stopped lending, worried they wouldn't be repaid. Credit, the lifeblood of economies, dried up, affecting businesses, governments, and individuals alike. A housing market problem in the U.S. became a global financial crisis, exposing systemic vulnerabilities. A pivotal moment in 2008 was the collapse of Lehman Brothers, a major investment bank. In September, Lehman declared bankruptcy, marking the fall of one of America's oldest financial institutions and sparking panic worldwide. Lehman's heavy exposure to risky assets led to its downfall. When it collapsed, panic ensued, stock markets plunged, and uncertainty gripped the economy. Companies and banks suffered huge losses, and the system teetered on the edge. Lehman's fall highlighted global financial fragility and deepened fears of a worldwide recession. For ordinary people, the crisis's effects were devastating. Millions lost their homes as property values crashed, and those with risky mortgages couldn't pay. Job losses mounted, and household finances crumbled as confidence evaporated. Savings were also wiped out as stocks and pensions lost value. For many, it wasn't just about numbers, it was about survival. This crisis was a wake-up call. Without financial planning and education, we're all vulnerable to shocks. To avert a worse disaster, governments took drastic action. The U.S. approved a $700 billion bailout, known as TARP, to stabilize banks and restore trust. This kept credit flowing, preventing a deeper collapse. The Federal Reserve slashed interest rates and injected money into the economy. While this averted a deeper recession, it raised questions about rising public debt and inequality. These actions showed the importance of government intervention but also highlighted flaws in financial policies. Warning signs before 2008 included soaring property prices fueled by risky lending. Banks issued loans to people unlikely to repay, creating unsustainable practices. The growing complexity of global markets was another sign. Institutions traded opaque financial products, like CDOs, without fully understanding their risks. Regulators also failed to act, allowing speculation and debt to grow unchecked. Ignoring these red flags led to a global collapse, proving the need for better oversight. Now, let's focus on how you can protect yourself from future crises. There are practical steps to safeguard your finances and reduce risks. First, diversify. Don't put all your eggs in one basket. Spread investments across assets like stocks, real estate, fixed income, and even international markets. This cushions the impact of any single market collapse. Second, build an emergency fund. Save enough to cover 3 to 6 months of expenses. This buffer lets you stay afloat without selling investments during downturns. Finally, keep learning. Financial knowledge helps you navigate market risks and make informed decisions, even in uncertainty. These strategies won't eliminate risk but will give you a strong foundation for tough times. As we close, remember, financial crises are inevitable, but preparation makes all the difference. Start by learning from the past and planning for the future. It's not about how much you earn, it's how you manage it. Knowledge is your best tool to protect your family and assets. Don't wait for the next crisis, act now. What strategy will you adopt to safeguard your finances? Share in the comments, I'd love to hear how you're planning for stability. If you found this helpful, like the video, subscribe, and share it with friends. Financial freedom is a journey, and you've taken a big step by learning about 2008 and preparing for the future. See you in the next video.